Hey, well, we'll go ahead and get started. So I have the pleasure of introducing Brian today. Brian and I have been working together for 19 years. When I hired him, I offered him a pay cut and he still took the job. So we're delighted that he decided to pursue a career at Halba Hargrove. He's worn many hats and has had a great and has grown tremendously with the firm. He's been the chair of our investment committee for 12 years and then recently moved to be our co-chief investment officer, and he's doing a very good job. But you'll be the judge of that. And with that, I'm gonna let Brian take over. He does have a Q&A box ready for you. So he wants those questions to come mostly at the end. Of course, you can start typing them as you go, as you think about them, but he will start answering those questions at the end. And with that, Brian, take it over, please.
Well, welcome everybody, and my screen should be showing at this point, correct? It's all good? Well, great. We have people from all over the country joining today, and I appreciate it. So good morning, good afternoon to all of you. What I will plan to do today is go through a number of things that we tend to look at, and it's going to be a condensed version of a lot of things that we look at, but I want to kick off 2025. And what we will do here is we're going to look at the 2024 market outcomes, and I don't just mean the U.S. stock market. We're going to look at a variety of different markets and financial assets in this presentation, and then move on to some of the economic factors to consider here, some of the uncertainties that exist in the markets today and even within the economic side of things. And then I'll wrap up with a couple of investment principles and some good reminders on things to consider as we go into a new investing year. So first and foremost, the one thing that comes out about this time of the year, usually towards the end of December, is major Wall Street banks and major Wall Street firms and banks also come out with forecasts for what the next 12 months look like on U.S. stocks. And a lot of the time it's focused on U.S. stocks because that gets the most amount of attention. And one of the things that stands out is we have finished 2024, obviously. And I went back and we pulled the year-end 2023 predictions for what was going to happen in 2024. And when you're looking at this slide across the top, this is just the measure of the U.S. large company stock index, the S&P 500, on a price return basis returned a little over 23% last year. This data set for the historical average goes back to 1927, so it historically has averaged about 12.3%. Now, you all being investors or owning stocks understand that it's very rare that you get the average in any single year. You tend to get outsized returns, outsized losses, and a lot of volatility in between. But what stood out at the end of 2023 going into 2024 is a number of these firms had positive predictions for what the market was going to do, and there was a significant chunk that had very negative predictions for what was going to come as well. And the point of bringing this up isn't to bash them, it's just an annual exercise they go through, and understanding that there are a lot of factors that drive markets, human behavior being one of them, and it's very hard with modeling to exactly forecast what's going to happen over a 12-month period. So when you get these types of forecasts or you see them, you might anchor to one of them. You might say, oh, well, this one's really negative. I like that. I want to get out of stocks. I just caution that some of these forecasts historically have about a 30% hit rate. So it's not ideal to use this as a tool to figure out how to position your portfolio, albeit they still send these out. And I want to show you kind of what's changed now going into 2025, polling these same exact firms that report into Bloomberg. And here we go. So you'll notice that there's nothing on the negative side. Every one of those firms that had made forecasts last year that reissued them this year, they're all positive. I don't know how much to anchor to any of this data, but one of the firms at the top is another 20% plus year. And if you think about it, stocks in the US to have 2 years back-to-back of 20% returns, which we've just experienced, to have a third year is even more rare. So we'll see what happens. But just keep that in mind as you hear about forecasts and how difficult they are in forming asset allocation views in a very short period of time. Moving on to the Candyland chart, this is what we refer to here as a Candyland chart. What you're looking at here is across the top are calendar years going back to 2010. And this covers 15 calendar years. And typically as we add a new year, an old year falls off. So what fell off here is 2009, which was a significant recovery year from the great financial crisis. And at the top of this, in each calendar year, there are boxes, all coded different colors. And I'm going to use 2024 as an example because many of you have seen this before. But if we look at calendar year 2024 on the far right, the top green box is US large company stocks. It's just an index. It's the S&P 500. Below that in orange is small US companies represented by the Russell 2000. I'll skip to the asset allocation further down in this commentary, but then you have high yield bonds or otherwise below investment grade bonds, emerging market equities in purple, commodities, cash in dark purple, REITs, real estate investment trusts, in call it an aquamarine light blue, and then developed market equities or international stocks in gray, and then fixed income in dark blue, represented by the US fixed income market index. And what you'll notice is that you go through time, these boxes move all over the place. The top performers sometimes fall to be the bottom performers. And in general, what we saw last year was the things that tend to have the most volatility over time, meaning the prices fluctuate the most, tended to do the best last year. So it was a good environment for risk assets. A couple exceptions that came into play, and they came into play in a very short period of time, is REITs and developed market international equities had a very tough last 6 weeks of the year as things unfolded and investors ran for the exits on those. But part of the developed market equity wasn't necessarily investors running for the exits. It was more the fact that the US dollar appreciated very strongly in a short period of time. The asset allocation line. So this is really getting to the discipline of what HH does. We don't invest in every single area here. We have from time to time had exposure to a variety of these things, but if we just take the public markets and allocate to more of a balanced portfolio, call it 60% stocks, 40% bonds, just using this, that's what shows the asset allocation line in the middle there. And what you'll notice is that when you diversify, you don't end up with the euphoria of owning 100% of what did best that year, but you also don't suffer being at the bottom here. And it's really about trying to make sure people don't end up in the worst bottom performer here and have too much of their portfolio allocated to it, because cycles do happen, things come in and out of favor, and it doesn't always mean what's the best performer in one year is guaranteed to be the best performer in the following year. So that's just representation that the asset allocation line, just by default of diversifying and owning everything here, you're never going to end up at the top, but you also by default will not end up at the bottom either. I'm going to drill down into US equities here. So we're going to talk about large markets or large cap stocks, and then I'm going to move into international, and then I'm going to move into the fixed income markets, because all of those are important. It's not just about what US stocks are doing. And I thought this was of interest to share with all of you today. And it's simply because there are parallels, or we do get asked about parallels to the dot-com era. And if you think about going back to 2000, 2001, 2002, when the dot-com bubble was deflating, if you will, there's been some parallels to the huge tech influence that the market has today versus that period. And are we in a bubble? And I want to look at some valuation metrics. So in these red boxes, I highlighted 3 periods here. You'll notice a comment about PE forward. What that is it's price to earnings. It's a valuation metric, and it's basically telling you for every dollar invested, how many years of earnings are you buying, future earnings are you buying. So if you think about in March 24th, 2000, the market, the S&P 500 was trading at 25 times earnings. And it was a lot lower of an index level in that era as well. And then you can see what happens as the market sold off, valuations became more attractive, they were lower. But since then, we've had a financial crisis, and then post the financial crisis have had a massive run up in the overall index level, leading people to believe that the index has gotten way too expensive. And I wanted to highlight, we really haven't had much of a valuation change from 2022, so at the beginning of 2022, before the market sold off in that calendar year, to where we are now, even though the index level has risen. And the main reason for that is earnings. The denominator has grown with the price of the index. So the companies that represent the index today, the dominant companies that represent the index today, are in much different financial shape than the companies that were representing the index in 2000. So just keep that in mind, that a lot of the time there's parallels thrown with the dot-com bubble. I'm not saying it doesn't mean the market can't go down. It's just we are dealing with a different circumstance of companies and financials at this point that represent this market. More on valuations within the US large cap market. So on this chart in particular, that gray squiggly line that runs through the middle is charting the price to earnings ratio that I just referenced on the previous chart, and showing it on a standalone basis without the market levels or index levels there. And when you're looking at this, there's a couple dotted green lines here. The note of this is really to look at what is what is considered a high PE or high priced earnings ratio relative to what's low here. And as you can see, as market goes through time, especially back in 2008, the market was trading at a very significant low PE post the financial crisis, and has since then run up. But where we're sitting today on the far right-hand side within US stocks is not nearly the same level that we were at the peak of the 2000s on valuations overall. It is expensive though. It is trading at much higher than the 30-year average here, which sits around 17 times earnings. I'll delve into a little bit of that as we drill down a little bit further into the index. The one thing to note, I put a red box on the screen here, and I don't expect anyone to know what this is, but I'll explain it. The EY is the earnings yield minus the BAA yield, which is investment grade bonds. So what it's looking at here is taking that price to earnings ratio of stocks, flipping it on its head, so it's now the earnings over price, and trying to compare that to where investment grade bond yields are at this point to try to level the playing field on valuations. And what you'll notice is that stocks relative to bonds by this metric are expensive. Now, valuation, we stress this continually, that valuation doesn't tell you what's going to happen in a short period of time. I will tell you on the next slide that it can be indicative of future returns. If valuations are high, things of that nature, what happens generally. But in this case, it is sat negative now for about 2 years. Bond yields have risen drastically, and that's made them more attractive as their prices have come down relative to stocks at this point. So fixed income in general, we'll get into this, is at a different valuation level than what US large cap stocks are at this point. So let's talk about price to earnings and valuations and what they tell you about the future, if anything, because like I said, I've already talked to you about forecasting being all the uncertainties you have to factor in to get that right, plus valuations being where they are today. What does it tell us? So I shared this about 6 months ago when we did a mid-year market update, and it's been updated a bit here. So what we're looking at on the left-hand side are the PE ratios for those various periods plotted, and they're the gray diamonds, and where we're at relative to today. And along the bottom, each x-axis of these two charts are the price to earnings multiples, and along the y-axis, the vertical axis, is what the returns were. And what we do is we look at the left-hand side. If you have a high PE, what does that tell you about the next 12 months as far as where returns can be? And you'll notice that they're all over the map. There's nothing that can kind of tell you that there is any sort of pattern here. So what it really tells you is that on short-term basis, valuations really do not have much of a predictability capability with them. However, if you slide over to the right-hand side of this, What it does start to tell you is that when you are paying up for an asset, when you're paying a higher price for an asset, generally when you've had higher PEs, that tends to lead to lower return outcomes. It doesn't mean catastrophic, you're going to lose a bunch of money. It just means that when you're paying a higher price for an asset, you're in a way paying for a much longer earnings return stream there. And what has historically happened is, markets get expensive, they don't necessarily repeat what's happened in the recent past. And so I use this just as an example, like, don't get ahead of yourself and think that we're going to have necessarily a repeat of US stock performance in the short run here, as valuations are a little bit high. And, historically speaking, that has led to lower rates of return versus what's happened when they are cheaper valuations. Drilling in, I'm going to cover both the top 10 stocks and the Mag 7 or the Magnificent 7 here pretty quickly, but I do want to talk about some things with regards to indexes, ways to measure markets, and the concentration that we are facing today. So if we look at the upper right-hand side of this, there's the weight of the top 10 stocks. So these are the largest companies by market weight, meaning what they make up of the index at this point. Going back to the mid-90s, and you'll notice that about those 10 stocks make up almost close to 40% of the index at this point. That's the highest we have seen it since the mid-90s there, and it's continued to grow over the last year, and it's continued to become a much larger concentration. So said differently, the index today is less diversified. It's more dependent on fewer names now to drive returns than it historically has been. Slide over to the right-hand side, there's a box in the upper left-hand corner, and we now can start breaking down those top 10 stocks by valuation relative to the remaining stocks that are represented by the index. And the top 10 stocks currently are trading at about 30 times earnings, so 30 PE. I'm rounding up here. And historically, those have really ranged in about 20 times earnings or 21% or 21 times earnings there. So they're about 145% more than their historical average as far as valuations. The remaining stocks much cheaper, trading at 18 times earnings when historically they've traded around 15 and a half. And then the broader index there at 21 to 21 and a half, trading about 130% ahead of its historical average as far as valuations. So we've seen a big move in valuations on those top 10 stocks, but it's not been because it's just a hope for the future. If we look in the bottom right-hand corner there, these companies have contributed a significant amount of the free cash flow, the CapEx, the operating income. These are performing companies. These are not companies with no revenues on a hope that something's going to change the world. These companies are very financially strong, and they have contributed a lot to the index, albeit the indexing methodology has now overweighted them because of that performance relative to other stocks in the index. And then here's another area that I find interesting in the sense that if we drill down to a fewer subset of stocks, so what is called the Magnificent Seven, which are the Apples, the Amazons, the Googles, the Metas, the Microsofts, NVIDIA, and then Tesla. If we drill it down from top 10 to the top 7 here, look at the upper left-hand corner. The share of returns that they have generated for the index, meaning the index return, how much of that was contributed because of the Mag 7 performance. In 2022, 2023, and 2024, it's been over 50%. So over 50% of the index has been driven by 7 companies. A lot of those companies underneath the index haven't come anywhere close to that. And you can kind of see here why that's the case. If we look over at the earnings growth side in the upper right-hand corner, those green boxes or those green bars are those Magnificent Seven companies' earnings, and they have been widely disparate from the other 493 stocks in the index at this point. So, they rightfully have earned their place, but what we're starting to see, at least as far as estimates going forward, and these 493 companies do need to perform on their earnings, is that you're starting to see a broadening out, more contributions to the earnings of the index because of those ex-Mag 7 companies at this point. So it would be nice to start to see some more diversification of returns within the index and less concentration on just a handful of companies at this point. I could throw this slide under more of a good reminder, but since we're talking about US stocks and just equities in general in this part of the presentation, I do want to remind investors that when you invest in stocks, even if you're investing in stocks in a diversified portfolio with other assets, you have to recognize that historically, when we look at just what equities do, what you're looking at here is by calendar year going back to 1980 here. The price return of the US market, if the gray bar is in the positive territory, that's where it finished the year in each data point. If it's below that 0% line, it was a negative year. And those red dots that you see with numbers next to them, those were the largest intra-year decline in those specific calendar years. It doesn't mean the market didn't only decline once. There could have been a multiple of corrections. These were just the largest corrections in those calendar years. And what's gone on is historically, on average, investors should be comfortable if you're going to invest in stocks, being knowing full well that within a calendar year, you should have roughly a 14 to 15% drawdown at some point within that calendar year. Now, the benefit is if you don't do anything, you don't panic out and sell. Historically, 75% of the time, the market finishes positive. And the other 25% are those years that you see represented that are below 0%. So you do have to suffer quite a bit of volatility as a stock investor, but holding on long enough, you tend to get much more probability of better or positive returns than negative returns. So just keep that in mind. Last year and the year prior, we didn't get anywhere close to a 14 or 15% correction. The worst was down 10 in 2023, and we were down about 8 last year. So historically, right now, there's been lower drawdowns in the last 2 years, but we don't want people to think that that's typically the normal. Let's move outside the US markets and start looking at international equities and where valuations are there. So if we hear the comment, oh, all stocks are expensive, I'd point to the left-hand side of this and say, well, not international. If we compare international, so companies that compete and trade in foreign markets, they're on average right now trading at a 38% discount to a US counterpart at this point. Historically, international has always traded at a discount to US companies, but in this case, it's double what it historically has been. So international is very cheap right now. Like I said, it's not a timing tool, but if you're looking for values, you're looking for things that are not expensive at this point, the international stage has that opportunity to it to help diversify away from US equities. And if we slide over to the right-hand side, what you're looking at here are all the sectors we have within the S&P 500 and within our markets. You're looking at these same sectors in the international market, and the gray bars tell you historically over the last 20 years how much each of those sectors in the international market trade at a discount to the US. Healthcare being the one exception that has traded as a premium against the US for a period of time. But if you look at the purple diamonds, those sectors are even cheaper by almost all of them across the board, cheaper than the same sectors within the US right now. So they're pretty widely pushed to the left-hand side of this. And to note, these are public markets, but what we do see at this point is that these discounts, these valuation discounts that are existing between the US and international, these are drawing the attention of the private markets and private capital because they're seeing such a big discount. It's just a matter of time before public equities maybe recognize this. And the other thing is that we've talked about the disparity between US and international valuations. I want to talk about if we take all the stocks that trade globally and start weighting them by their contribution or their valuations or their market capitalizations, where do they sit relative to each other? And I think the top right stands out the greatest. So this goes back to the mid 80s, but the US market capitalization relative to all stocks that trade globally is at its highest point at this point in time. Almost 67% of the global publicly traded stock market is US. And there are a lot of other countries in there, but the US continues to grow its market share, if you will, or valuations. And that has historically not been that high. So it's just something to point out that it's how much of the US is going to keep dominating the global stage for equities. And sometimes, we'll hear a comment or two, depending. I don't really care about what the rest of the world is doing. The US will be fine on its own. And I would go to the bottom right-hand side and say, you really do not want the rest of the world to fall apart if you own US stocks. And the reason for that is about 40% of the revenues from the S&P 500 or those types of companies come from outside the US. So they are drawing revenues from international markets and international economies. You do not necessarily want that 40% to go away, because that is a contribution to revenue. That is a contribution to what stocks are getting priced at today. So just note that a lot of revenue on domestic companies here in the US does come from outside the US at this point in time. So enough about stocks. Let's talk about enough about that in stocks and valuations. I want to talk about valuations on fixed income now. And I talked about concentration within our indexes, concentration within the international indexes relative to the US. And I want to talk about where the fixed income markets are trading relative, or at least how that index is constructed relative to its past. And if we look at the red box down in the left-hand corner here, this is a measure of index, a commonly followed index of the US fixed income market. And what you'll notice here is under the category of US Treasuries now represent 44% of that index. So if you're just buying an exchange traded fund that tracks the US bond market, 44% of that fund is invested in US Treasuries at this point. And you may go, well, why is it getting so high? The way that index is constructed is you end up with an index that's looking for how much debt an issuer has put out on the market. So the more debt you put onto the market, the greater your allocation is within that index, the way it's constructed. So the US government, being a high issuer of debt and treasuries, has made up and continued to grow that percentage. Call it 10 years ago, that was down in the 30s. It's now in the mid 40s and continuing to grow. Whereas other things like investment grade corporates, mortgage-backed securities, commercial mortgage-backed securities, and asset-backed securities have started making up relatively lower amounts of the index. And we see this, just as a firm, to tell you where our positioning is, we see this as a great opportunity for active management versus index investing at this point, because there's a lot of different areas of the bond market being much larger than the equity market, a lot more opportunities to invest in fixed income securities across the board and have less dependency on treasuries. And those blue diamonds there across each of these fixed income categories, to note, those are where they're currently priced and what the current call it yield is. It's yield to worst, but which pretty much means you should look at that with a high confidence that if you buy at today's prices on each of those categories, you should be able to get that rate of return in the next 5 years. And I'll show you why in a moment here. But active management is taking note of this. And a lot of the good active managers in the fixed income world have been able to move between these areas pretty nimbly and extract the returns. It's a little easier with fixed income. Somebody's going to punch me for saying that, but with fixed income, really what your goal of return is to collect all the interest and get your principal back. It's not on the hope that things rise in price and go up like, say, an equity or a stock would do. In this case, you're more in a contractual income stream in which you hope to get paid all your interest. And if the creditor doesn't default, meaning go bankrupt, they will pay you back all your principal as well. So if we just look at the US fixed income market, just as an index level right now, where we're priced at, where yields are at, meaning the interest you're earning off just the broad market, a current yield right now, roughly of about 4.9% with a forward 5-year return running just above 5. So if you think about fixed income or investment grade fixed income relative to cash deposits or like the 3-month treasury, something safe and short term, you are now, this has flipped a bit now, you are now able to, since the Fed has been cutting rates, to earn a higher rate of return, higher level of income out of investment grade bonds at this point relative to cash. And that's something that is much more normal to see over time. And we have finally gotten there. So if you're buying fixed income today and you're not taking a ton of risk, returns above, returns above 5%. Let me go back there. I hit the keyboard. There we go. The returns above 5% seem pretty doable here within the next 5 years on fixed income. So that goes back to the valuation comment on fixed income being pretty attractive relative to, say, some other areas. I'm going to move over to the economy side, and there's some things that when we break down the US economy, there's some important factors to consider. Just for example, how is our gross domestic product weighted at this point? What's the important factor in there, and what's going to drive either growth or contraction within our economy? And I'll point to the upper right-hand box again. If you look at consumption, that makes up 68% of our GDP. The second largest spender in there is government, but at 19%. So the main point of when we look at GDP, or when you focus on GDP, is that when you hear positive GDP growth numbers, it's really about what's the consumer doing in the US. And you need a resilient consumer to continue driving GDP at this point. Yes, government spending is second in line to that, but it is a distant second as far as its weight and contribution to economic growth in this country. And I'll get a little bit more to the consumer in a moment, because the consumer is so important to economic growth in the country. Let's talk about federal finances, because this is obviously a focus of the market. It is definitely a focus of interest of the fixed income markets and interest rates, because the federal government does issue treasuries into the public market, which then determine how much they're willing to accept as far as interest to take on that debt from the government. And if we look at the total government spending, I know there's talk about cutting spending and a number of things to try to get us to more of a balanced budget. But right now, the total spend estimated for 2025 is $7 trillion, with a deficit close to $2 trillion. And so when we look at the various components of what makes up the spending, if we start at the bottom of the stack here, total interest payments, they're not going to be able to change that, because that's dictated by what the market charges on the US Treasury rate. Social Security, Medicare, Medicaid, those are call it entitlement programs that they're a major political football to touch at this point, but they make up a significant chunk of the spend. And then other mandatory, which won't have much ability to touch. Then you have defense, and you have non-defense discretionary. So you have the purple and the orange. And even if you cut both of those out, you still don't have a balanced budget. So really where it's going to come down to probably down the line is either raising revenues or figuring out ways to modify the Medicare, Social Security, and Medicaid system, which are the largest entitlement programs that are driving government spending at this point. And then further down, we're waiting on this to see what things transpire as far as tax code this year, because we are going to have tax policy and that's currently in place expire at the end of this year, and we will have to have either an extension of that or changes to it. But if we look at something you will see in the headlines, what is our federal national debt relative to our GDP? And a lot of countries get measured and compared this way. And if we look at the 2024 and you can kind of squint, you'll see that where we ended 2024, it was about 98%. So we were anticipating we probably would have hit 100 by the end of the year, so 100% debt to GDP. And with the Tax Cut and Job Act extension, if it does continue, which is the tax policy we're under right now, they are projecting that debt to GDP ratio is going to continue to climb. Even if it gets modified and reverts back to where we were before calendar year 2017, even then the debt to GDP is still continuing to grow. So it does not appear that we are going to be lowering that, but that is also a concern within call it the fixed income markets, where you see rates get volatile. It's just a matter of, do we need to charge the US government more for interest in order to take on the creditor risk that keeps rising with this ratio? More on inflation. So let's talk about inflation, because that's going to continue to be a focus of the markets this year. It was a focus over the last two to 3 years, more or less, in markets, and it's continuing to be. So when we look at inflation, I call this the shark fin graph, because it looks like the back of a shark here, where we saw in 2022 inflation, the rate of change of prices, hit a peak of 9%. Since then, it's been coming down, and then it got stubbornly stuck around 3%, and it's finally broken below 3%. The print I show here is on November 2024. It's at 2.7%. Got a print yesterday for December at 2.9%. So inflation has been stubbornly sitting in that call it around 3% range right now, when the Fed is really trying to aim for 2% level. Couple components of that have been very sticky and they will continue to be very slow to bring down are things like auto insurance, which prices have gone up a lot there. It's just whether or not they're going to continue rising. And then shelter, it's been slowly on a trajectory down, but it's not going to correct itself overnight. So more or less, you're going to hear fighting over inflation this year. Will it resurge? Don't know. Will it continue to call it trend towards that 2%? That is also an unknown, but there are a couple components that are making it very difficult to get to that 2% level in a short order. This is all stuff the market already knows and is priced in. What is on here is already priced into the markets. It's just a matter of what's the future direction. Where I want to make a point, we talk about inflation and you talk about 2.7% or 2.9%. That's really not what has people mad, I don't think. I think where people are upset is really at something called the price level. And thinking and anchoring to prices from 2019, going into the grocery store and seeing where they are today. Yeah, the prices aren't fluctuating a whole lot year over year now, but the overall price level has risen so much because of those years of inflation that we've had, that to get them back to calendar year 2019 levels, we are going to need to see a pretty significant amount of deflation. So in order to get that, I don't want people to confuse price level with the rate of change of it, which is the inflation measure here. But really what has people so upset is that the overall price level has risen so much. Yes, the rate of change of that has been coming down, but it's not, the price level is not receding back to levels that people were used to 4 or 5 years ago. So focusing on the consumer again, because they're an important aspect of our economy, like I said, 68%. Overall, the consumer in the US is very strong. I will show you another example of this. That is the good news. A lot of the liabilities that you see down on the left-hand side here, a lot of the average consumer liability is in mortgages. A lot of those locked at fixed, very low fixed rates right now. So the consumer is not really getting slammed too hard by the rate increases that we've seen over the last 2 years. If we move over to the right-hand side of this, the household debt service ratio is also, it came down quite a bit from 2008 and the financial crisis, where we had a lot of over leverage. And it currently, the way it's sitting right now, it's nowhere back to those levels and is kind of sitting where it's been since the 1980s. The one area that stands out, if we move down to the bottom right-hand side of this, the one area that does stand out a little bit here is if we look at the flows into delinquency, auto loans and credit cards have been peaking up. Mortgages have, albeit not very high, but the auto loan defaults and the credit card defaults have been going up. And you really have to kind of parse out what's driving that. And unfortunately, with the recovery we've been in, that is predominantly lower middle class or lower income areas that had to take on these types of loans in order to keep up with inflation. And you're starting to see the defaults pick up there. Call it a warning sign, but remember the broad consumer, the way it's all compiled, is still in good shape. And I'll show you that relative to the rest of the world. So if we look at the US consumer here, the debt to disposable income, you'll see the green line, that's the US. And it was rising quite a bit up until March 2008 financial crisis time. And ever since then, households have been essentially repairing their balance sheets and getting into a much stronger position than, say, where they were 15 plus years ago. However, looking at two other developed economies, Canada and Australia, they've never had that reprieve that we had with the consumer becoming stronger. So more or less, the consumer is in excellent shape. That does spell well for GDP growth, as long as the consumer doesn't get spooked and pull back. But the US consumer is in a strong position at this point, which is important for our economic growth. Now to the Fed and what the market is saying. So the Fed and the market don't always agree, and that shouldn't be a surprise. But since interest rates are a very important part of asset pricing, wanted to look at what's the market saying, or what's the market thinking and pricing in today relative to stocks and bonds on what the Fed's next move is going to be. Are they going to cut more in 2025 or are they not? And if we just look at what the dark blue diamonds are saying versus the green is the market. And the market is basically saying, we're not believing that you're going to get many cuts in this year. So for 2025, we aren't pricing in expectations that you're going to be on a severe cutting campaign, whereas the Fed has disconnected from them and said that there is some level of cut expectation that's greater than what the market's pricing in at this point for the next couple of years. This is flipped. If we ran the same thing when we ran at 9:30 of last year, the market and the Fed were pretty closely aligned. But with regards to strong economic numbers that came out, the market eventually said, hey, we overdid it and corrected. And we don't think that the Fed's going to have much room to cut rates to stimulate the economy because it's already so strong. And now to the uncertainty that faces the market on the economy side, both from an inflation standpoint and from just the sheer fact of uncertainty about what risk assets or stocks may behave like. This is looking at tariffs going back to the 1930s as a part of consumption in the US. And what you'll notice is in the 30s, tariffs were very high, and they have since been coming down pretty drastically to where we are now. If we take, which this is the big uncertainty, no one knows exactly what's going to happen with tariffs, but if we take all the proposed tariffs in place, it goes back up to the level of the 1930s here. And I think that's really what markets are fretting about. They're trying to figure out how much of this is really going to go into effect. Is it going to impact inflation, meaning higher tariffs? And if that's the case, is that going to lead over into lower consumption, the consumer pulling back because prices have gone up so much, i.e. getting into more of a stagflationary environment where that's not particularly great for financial assets, but these are the worries that markets are focused on. And I would say is going to be a topic of 2025 to see either how pointed the tariffs are or how broad-based they are. So even with the face of uncertainty, which every year looking into the future is always uncertain, I wanted to look at just two good reminders for portfolios. So if we just take a publicly traded portfolio, meaning everything's daily liquid, it's not invested in private assets or anything, but 60% stocks, both a combination of US and international, and 40% bonds. And you look back since the 1980s, what you'll notice is most of the time, a balanced portfolio, despite all the worries, everything that comes through, most of the time, a balanced portfolio does produce a positive rate of return in the calendar year. There are some of the exceptions that people anchor to. For example, on the left-hand side, 2008, 2022, which was only 2 years ago, but a pretty significant drawdown in both stocks and bonds. And then the 2000, 2001, 2002 era, Um, the one thing that you'll notice is when you get extreme sell-offs in a portfolio like this, so, down 15, down 20, what you'll tend to notice is that the following year tends to be the best recovery year. And so for things like 2008 and 2022, well above 15% returns following that. So my main premise for showing this once again is, things do go down in financial markets, and it's about keeping your cool with regards to this, because generally what will happen is after things have gone down, that's when people will sell, only to miss usually the possibility and the high probability that the following year is a snapback and a recovery. So just remember, we can have drawdowns, or all portfolios can have drawdowns, but focus just really on historical guidance here, in the fact that you generally will get a recovery year, and it's usually meaningful before people jump back in after selling. They usually miss that really good recovery year, which is detrimental to long-term performance. And and I'll finish up with this, but lastly, I've talked a lot about public markets and the areas of both fixed income, US stocks, international equities, and I've even referenced the 60-40, which you will see a bubble here. If you want to diversify, and this is something that we've been doing for well over 10 years now, if you want to diversify outside of just public assets, there's a lot of opportunity in private markets to earn much higher yields, lower the risk in the portfolio, meaning how much they move around relative to public markets, and be able to layer in some assets to the portfolio that behave differently. And in the case when you go into the private markets and you're investing in private markets, the one thing you are giving up there is liquidity, in the sense that you can buy and sell stocks and bonds throughout the day. In the private markets, you are giving up that liquidity and that ability to sell at any given moment for an allocation to an area of the market that you can't get access to. So things like taking the 60-40, so the 40% being bonds, you can diversify the bond side of that by going into things like direct lending, which has very high rates of return, high rates of yield, and a much lower correlation to the traditional fixed income markets. Same thing on the fixed income side. You can go into core real estate, rental income, very stable, tends to have a negative correlation to fixed income and equities. And then if we want to diversify further, thinking about the stock side, so you have US stocks, international stocks, the private equity side has historically been slightly less correlated to the public markets and provided a much higher rate of return on average over time. But remember, it is illiquid. The pricing is infrequent to these, but these are ways you can diversify a 60-40. And this is something that HH has spent a lot of time trying to be able to give access to clients to help diversify their traditional exposures in their portfolio. So I wrap this up, and I'm going to go over now to the Q&A box and see if there are questions here. So we have one on page 19, so I'll go up here. That's a good question. I will look into that for you, because the EU is roughly, my guess, roughly similar to that. I got a long one here. So let me go back to, this was a question on what's going to cause some of this gap to close. So what's going to cause some of the gap to close is eventually at some point people are going to recognize these companies do earn money, and the baby has been thrown out with the bathwater. A lot of the time, what's gone on here is these are very strong. A lot of these companies that you see in these sectors are very strong companies. They just operate or really sit in countries where there is political dysfunction at this point. but they're still selling a lot of products globally, and they're still, driving revenues very similar to what the US does. Historically, that has been the reason for the valuation discount. It's just gotten so stretched at this point that it's just a matter of time before capital flows start going back there. And one of the major factors that would cause that to close is when the dollar goes through a cycle of decline. So the dollar goes through long cycles. It went through a period where it dropped relative to foreign currencies. It is extremely very strong, which makes us less competitive globally to sell goods abroad. And at some point, that dynamic generally does flip. It's just a matter of when that no one knows. Question on, is investing in private real estate for a member of family advisable? Once again, I will say, I can't make a recommendation on a single asset for an individual I don't know, but broadly speaking, with the way to think about core investment real estate, so large scale, what institutional investors invest in, it's generally been as a fixed income replacement, a way to generate income over and beyond what bonds do, and have a way to diversify, be less interest rate sensitive, and things of that nature. And also, in a way, real estate over time has been an inflation hedge. But I don't know what else they own, so we would have to assess if it's too much concentration for a portfolio, because it's not bulletproof. Real estate does go through cycles as well, just like any other financial asset. And it's just time horizon and liquidity that they need to factor in as well. How attractive do current fixed income returns look in light of inflation expectations? So you're actually seeing with current inflation expectations, I showed on one of the fixed income charts here that if you can get 5%, and if inflation stays at, call it just below 3, you are getting a spread on fixed income right now over inflation at this point. We were not getting that a few years ago when interest rates were held artificially low. But now with the market adjusting to higher rates, and with the market also, the market really dictates everything beyond what the Fed sets, which is the overnight rate. And you are seeing at this point in time that if inflation does truly stay, I call it in that 2 to 3% range, you are getting compensated there overall. Thoughts on crypto and opportunities in crypto? That's a good one. So and then the other part of that question is, what about crypto ETFs? And I'll keep this pretty broad because that's a conversation in and of itself. But the way that we have approached digital assets or crypto, things like Bitcoin, things like Ethereum, is there are now ETFs out in the market, or exchange traded funds, that make this very accessible to retail investors to put into a normal brokerage account. And that's been a pretty big shift in the last 12 months, because they came out at the beginning of last year. Things like Bitcoin getting a lot of attention. What we do with that is we look at it as kind of an alternative asset class. It is a very volatile asset to own, meaning it fluctuates a lot. And if you're going to put it in a portfolio, it has a complete different characteristics than most other things in a portfolio. So when we talk to investors about it, if they're dipping their toe into this area and they're willing to deal with the volatility, a 1 to 2% allocation of a portfolio is generally a starting point that we would consider. A lot of those investors felt the 2021 and 2022 massive declines in those areas. They've also seen the tremendous benefit of having a very small position in a very growth-oriented asset overall. But I'd say, Bitcoin has still has the largest market share. It has limited supply to it. It is different than almost anything else that you would own in a portfolio, and we don't think it's necessarily to be ignored at this point. And it is something that people should be talking with their advisor about if they want it in a portfolio. Along with crypto, why not have an AI ETF for a small investment percent? I'd say in a way, the S&P 500 has become an AI ETF at this point. Those Mag 7 stocks, a lot of those are being driven by it. So unless you wanted to go more concentrated than that, there is a lot of AI movement currently priced in on the S&P and weighted on those companies as well. But you can punch me later for that one. But there is a lot of that benefit. That's what's been really getting the market out of the rut from 2022 at this point, is predominantly the AI theme. So we've come up on the top of the hour, or the bottom, sorry. We're right at 12:30, so we had an hour for this. I appreciate everybody attending. Thank you for your time. And if you have any questions or follow-up, your advisor here at HH will have these slides. You will also, since you registered, have a recording of this as well, roughly 2 weeks out, like JC said. So thank you again. Welcome any other questions that come in. Please speak with your advisor and we'll try to answer them as quickly as we can. Thank you all. Appreciate it.